Four words: index funds, mutual funds, hedge funds, ETFs. They sound almost the same, but the one you pick could quietly decide whether you retire rich or hand a stranger 30% of your money for doing worse than a coin flip. In the next 10 minutes, I'll explain all four, and with nothing but stick figures and a birthday party. Let's go. Okay, quick promise. By the end of this, you'll know exactly what each of these four is, who's secretly running it, what it costs you, and which one is actually right for you. One tiny thing first: this is not financial advice. I'm a stick figure with a marker. Cool? Cool? So, let's start with the dumbest, most important question of all. What is a fund? Imagine you and your friends are throwing a birthday party. Instead of one person paying for everything, everybody throws a little money into a hat. With that pile, you buy food, drinks, decorations, cake, even a guy with a speaker. Nobody goes broke, nobody does all the work, and everybody gets the party. That's a fund. A bunch of people pool their money, and that pool gets invested into a big mix of stuff: stocks, bonds, real estate, and you all share the results. That's it. You already understand funds. The only real difference between our four contestants is who manages the hat and how much they charge to hold it. So let's meet our four contestants: the cheap crowd favorite, the expensive cousin, the velvet rope billionaire, and the one that quietly beats most of them at their own game. First up, the people's champion: index funds. The ones every finance creator screams at you to buy. Here's the trick: an index fund doesn't try to pick winning stocks, it just copies a list. That list is called an index. Think of it as a scoreboard for a chunk of the market. The most famous one, the S&P 500, tracks 500 of the biggest companies in America. The bigger the company, the more space it takes up on the scoreboard. There are other indexes too. The NASDAQ, packed with tech giants like Apple, Microsoft, and Amazon. The Dow, just 30 huge names like Coca-Cola and Boeing, plus indexes for small companies, whole countries, you name it. Because nobody's sitting there picking and choosing, index funds are passively managed. And that is the magic. No expensive manager means the fee, called the expense ratio, is tiny, often between 0.02% and 0.20%. Translation: put in $1,000 and you might pay as little as 20 cents to $2 a year. The big names running these are Vanguard, BlackRock, and Fidelity. And because your money is spread across hundreds of companies, one company having a terrible year usually won't sink your ship. One weird thing to know: you can't buy an index fund midday like a stock and lock in the price right now. They're priced once a day after the market closes. That number is called the net asset value. So if you put your order in at 11 a.m., it actually fills at the closing price around 4 p.m. For long term investors, totally fine. And the kicker: index funds are low cost, low effort, and historically they just work over the long run. It's why even Warren Buffett, as maybe the greatest investor alive, tells most people to just buy an index fund, because beating the market year after year is brutally hard. Remember that. It matters in about 30 seconds. Contestant 2: mutual funds. At first, they look like index funds twin. Pool the money, spread it across lots of stuff. But here's the big difference: most mutual funds are actively managed. That means a professional manager, or a whole team in suits, is constantly buying and selling, trying to beat the market. Sounds great, right? Pay a pro, get better results. Here's the catch: active management is expensive. Mutual fund expense ratios usually run 0.5 to 1.5%, sometimes more. That's not 20 cents per thousand. That's $5 to $15 every year, every thousand. And remember what Buffett said: studies show that most actively managed funds don't actually beat the simple index they're trying to beat. So a lot of the time you're paying more for less. Ooh, so why do people still buy them? Sometimes they truly believe in a specific manager's strategy, or they want into a niche, a certain country, sector, or asset type. That's hard to reach otherwise. Big names here: Vanguard, Fidelity, and JP Morgan. And heads up, some of their funds are active and some are passive, so always check which one you're actually buying. Now, contestant 3: hedge funds. And this one is a totally different animal. The name comes from hedging risk. But ironically, modern hedge funds are usually about chasing huge returns with aggressive, complicated moves. A hedge fund is a private club. It pools money from wealthy people and giant institutions, and it invests in basically anything: stocks, bonds, real estate, currencies, and exotic stuff like derivatives. But unlike our first two, hedge funds pull out the power tools: short selling, betting that something goes down, leverage, borrowing money to bet even bigger, and complex derivatives. Done right, that's massive profit. Done wrong, it's a massive crater, which is exactly why you probably can't even get in. Hedge funds are usually only open to accredited investors, people with high income or a high net worth, because the risk is no joke. And the fees, they're famous. It's called 2 and 20, a 2% annual fee on everything you invested, plus 20% of any profit the fund makes. Last contestant, and honestly, the crowd's quiet favorite: ETFs, exchange traded funds. Think of an ETF as the love child of an index fund and a regular stock. Like an index fund, it pools money and gives you instant diversification across tons of assets. But like a stock, it trades all day long on the exchange. That's the superpower. You can watch an ETF's price move in real time and buy or sell whenever the market's open, no waiting for some 4 p.m. closing price. And the fees are beautiful, usually 0.03 to 0.75%, often lower than active mutual funds. Most ETFs are passively managed, meaning they track an index too. So if you want the S&P 500, you can get it through an index fund or an ETF. Same idea, different wrapper. And the cherry on top, tons of ETFs trade with zero commission on most brokerage apps. Okay, final scoreboard. Let's line all four up. Index funds passively track a list, dirt cheap fees, trade once a day, set it and forget it. The default for most people. Mutual funds: a pro, tries to beat the market, higher fees, trade once a day, and most of the time they don't beat the simple index. Good if you truly believe in a specific strategy. Hedge funds: private, rich people only, aggressive bets, brutal 2 and 20 fees, high risk and high reward, not built for the average investor. ETFs, index fund cheap and diversified, but they trade all day like a stock, often commission free. The flexible all rounder. See the pattern? As you go down the line, the fees and the risk climb. In the group, each one is right for gets narrower and narrower. So who wins? For most everyday investors, the honest answer is index funds or ETFs. They're cheap, they're simple, they're spread out, and historically they reward patience. Mutual funds can make sense if you genuinely believe in a manager or need a specific niche. Just go in with eyes open about the fees. And hedge funds. Those are for high net worth folks who can stomach big risk and big fees chasing big returns. Here's the real takeaway: the fanciest, most expensive option is almost never the best one for a normal human. The boring, cheap, patient choice usually wins. Buffett's been saying it for decades. That's all four. And you now understand them better than basically everyone in your group chat. If this made the money stuff finally click, do me a favor, hit like and subscribe so the next one finds you. And if you want to know exactly where to put your first $100, I made a video on that next. It's right there. Until next time, keep learning and keep building.